Hi, everyone, and thank you for joining us in today's BizTax webinar. Today's topic is U.S. businesses expanding to Canada. My name is Namir Hallak. I'm a U.S. tax partner with Andersen. Today, talking to you from beautiful Vancouver. And today, I'm joined with my brilliant colleague, Kristjan Luik, our senior manager based in Ottawa.
Thanks so much, Namir. So happy to be here today to discuss some of the corporate tax implications of doing business in Canada.
Well, Kristjan, I know I'm really excited to co-host this with you today. It's the first time for you on the other side of the panel with BizTax. And you've usually fielded questions for us from the audience. So I guess this time I'm going to throw our first question. Given that it's summer and we're in, I guess, mid-July, what song is on the top of your summer playlist today?
I just discovered a new artist, Sabrina Carpenter. She was on tour with Taylor Swift on her Eras tour and has apparently blown up this summer. So she has a few really catchy singles I've been listening to.
That's amazing. Are you going to manage to get some tickets to that concert when it happens?
We'll see.
That's awesome. Mine actually is Midnight Ride with Orville Peck. He's a fantastic country artist. He actually just did this song recently with Kylie Minogue. So he can do no wrong in my books. In fact, I've actually just spent the last 10 days stampeding with my always lovely Albertans, but I missed him by one day. So if you ever get a chance to experience the beautiful and welcoming community that is Calgary Stampede, I hope you get a chance to do it. All right, guys. Well, with that being said, let's jump into some of the housekeeping items before we start into our webinar. The National Association of State Board of Accountancy allows continuing professional education credits. To be eligible for this, you do need to watch 50 minutes of our presentation and answer all the polling questions. There will be 3. Once the webinar is finished, all qualifying attendees will receive a certificate. We'll leave some room, of course, at the end of the webinar for your questions. You can also ask questions to us throughout the webinar. Our panelists will bring those questions to Kristjan and I during the Q&A period. We will also send a quick survey after the webinar asking for your feedback and if there are any top-of-mind topics you would like covered in a future webinar. Finally, there is a live transcript option during the webinar. So please click on the CC button on the bottom of the screen to get this switched on. All right, so for today's topic, we're going to explore some of the tax issues and planning opportunities specifically for US citizens, our owner-managers, that are looking to expand their business into Canada. And we're going to try to keep it simple. And by what I mean by that is we're going to assume that the Canadian business operations that these US owners have are exclusively being operated and done in Canada and through a Canadian entity. So the goal today really is to provide you with an overview of some of the issues and opportunities to be aware of as a US taxpayer that now owns a Canadian entity. We'll start by looking at some of the differences that Kristjan's going to kick us off with on how Canadian corporations are taxed in Canada versus the US. We'll also be looking at some of the additional layers of taxes that were introduced that would impact US citizens that are residing in Canada that own Canadian entities. We'll touch also a little bit on trusts, estate taxes and estate freezes, really just outlining again some of the differences between how Canada and US treats those trusts. For example, looking at examples of how there's differences in the timing of the income, or even how they identify a taxpayer that's different in both countries. And then we'll close off by jumping into some cross-border tax planning strategies for US owners in Canada. So really our objective for you today is to come away hopefully with a few takeaways. One, consider having a really good cross-border tax strategy if you're a US owner, and try to, at minimum, avoid double taxation. Another key takeaway is, if you're talking to your Canadian neighbor or your Canadian friend and they're raving about how they have this really great structure and they're really excited about getting their, capital gains exemptions or their tax-free dividends from like a capital dividends account. Those are attributes that you as a US citizen or a green card holder may not have access to because the US doesn't recognize some of these Canadian concepts. So with that, I'm going to give the mic over to Kristjan, and let's get started on a discussion of how corporations are taxed in Canada versus the US.
Thank you so much, Namir. So we have a comparison here of the Canadian and US tax systems with respect to entity taxation. And as Namir mentioned, one of the common fact patterns that we see with our clients is a US citizen who's relocated to Canada and started a business here, maybe incorporated a professional practice or another type of business through a Canadian corporation. So similar to the US, the company is treated as a separate entity for tax purposes, and it pays corporate level Canadian tax on the business profits. So in Canada, we have a small business deduction, which is available to Canadian controlled private corporations. And if you qualify for the CCPC status, this deduction can effectively provide a reduced Canadian corporate tax rate on the first $500,000 of active business income each year. So at the corporate level, that can be a very attractive tax rate, which is meant to encourage these companies to reinvest the tax savings in the Canadian economy. The deduction can be limited for larger companies based on the amount of taxable capital that they hold. And also if the company generates investment income, it can draw down the ability to claim a small business deduction. It's also very important to maintain CCPC status to be eligible for this deduction. So then when the profits are ultimately distributed to the owners of the company, it is subject to a second level of tax as a dividend. And when you combine these two levels of tax at the corporate level and the shareholder level, it's intended to equal the approximate tax rate you would have paid if you had earned this income directly instead of through a corporation. So in Canada, one thing that distinguishes our tax system from the US is that Canadian companies can make an election to treat their distributions as a taxable dividend or a tax-free return of capital, or even the non-taxable half of a capital gain can be distributed tax-free to the shareholder. So this election provides another layer of flexibility for the taxpayer to manage the timing of income recognition at the shareholder level by deeming a distribution to be taxable or non-taxable.
And I guess, Kristjan, to that point, from the US perspective, though, I guess they wouldn't actually recognize that tax-free nature of the capital dividend, would they?
That's right. So in the US, the ordering rules are different. Where generally it's a taxable dividend first, to the extent the company has accumulated profits. And once that pool of accumulated profits is depleted to zero, any future distributions would be a tax-free return of capital that was invested in the company.
So essentially, those capital dividends can be taxed in the US on that same dividend.
That's right. That's right. So it could be treated with a different classification for US purposes. And generally, we want to align the timing and the character between Canada and the US to ultimately avoid double taxation. So down the road, when you look to selling your business, Canada has a very attractive provision called the lifetime capital gains exemption. And this can effectively exclude the gain on the sale of shares of a CCPC. The 2024 federal budget has proposed to increase the maximum exclusion to 1.25 million. So if that gain is excluded, it could provide very substantial Canadian tax savings. It is important to recognize that this exclusion is not available in the US. So if the shareholder is also a US taxpayer, the benefits of the exclusion could be eroded if those taxes are paid to the US. That's not to say that there's no way around it and no way for a US citizen to benefit from the exclusion. It would take some careful planning with a tax advisor. And similar to the small business deduction, you would want to be very careful to maintain your CCPC status throughout the operations of this company to preserve your ability to claim the exclusion.
Yeah, and it's interesting because I think the US, often Canadians are comparing similar rules that are available for Americans for US domestic corporations, because there is a similar exemption in the US for gains, and that's on the qualified small business stock. But again, that would only apply for US domestic corporations and not for Canadian corporations. So to your point, what happens for Americans caught in this is that where Canadians see that they could be eligible for the lifetime capital gains exemption, they might actually still be subject to the US capital gains tax for these CCPCs, the Canadian corporations.
So something to definitely think of in advance, have an exit strategy for the business, and plan to achieve the optimal tax consequence when you make that exit. So on the other hand, instead of selling the shares of a business, if the business was wound up and liquidated, the liquidating distribution would be treated as a dividend in Canada and a capital gain in the US. So in Canada, that dividend would not be eligible for the capital gains exclusion. In the US, it would potentially be eligible for the long-term capital gains rates at a lower tax rate. Just a few last comparisons of the Canadian and US systems here. Both systems tax residents on worldwide income. So there is a possibility of having income that's sourced to another country and still captured under the Canadian or US tax system. In those situations, ideally, there's a tax treaty between the home country and the country where the income is sourced, which will lay out which country has the first right to tax the income. And the other one generally has an obligation to grant a foreign tax credit for any taxes you paid to that first taxing country. And it avoids paying double tax on the income. One thing that's unique about the US is that they also tax their citizens on worldwide income. So in other words, if you leave the US, your tax obligations follow you. So this situation of having income subject to tax in two countries and the requirement to claim a foreign tax credit becomes very common for US citizens living in Canada, who are still subject to US tax on all of their income. And one last comparison that I want to mention right now is that the US has special rules that would deem certain entities to be flow-through by default. So in other words, any business profits generated in these entities would be taxed directly at the shareholder level, similar to a partnership, instead of having separate layers of tax at the corporate level and then shareholders when they receive a dividend. So in the US, entities such as partnerships, LLCs, and ULCs are treated as a flow-through entity by default. They can file an election to be treated as a corporation. Whereas on the Canadian side, we don't have this flexibility. So LLCs and ULCs are always taxed as a corporation, and a partnership is always treated as a partnership. I just mentioned this because the difference in entity classification can also result in timing differences that we want to be aware of. On top of that, the entity classification really has an impact in which legal entity in the group recognizes income and deduction. So it could potentially be a different entity recognizing these items in Canada and the US if they have different classifications in those two countries. If we could move on to the next slide.
Going to our first polling question then, right? All right, so this is our first polling question. It's a really difficult one. So conducting business through a corporation may provide greater flexibility in the timing, amount, and character of taxable income. True or false? And I think here, Kristjan, you're thinking about a corporation in this question to be either a Canadian corporation for the US owners who are doing business in Canada, regardless of the type of entity it is, whether it's a ULC or it's a corporate entity. We're thinking Canadian corporations, is that right?
That's right.
Yeah. Excellent. And all right, looks like most of you got that correct.
Fantastic. So despite some of these benefits that a corporation can provide in terms of managing the timing, amount, character of income, operating through a Canadian corporation also has some challenges that we need to be aware of. And I will dig into the potential accrual of income earned in a foreign corporation. Owners of a foreign corporation need to be careful of these tax regimes in Canada and the US that can impose a punitive or a burdensome tax treatment on those profits that are earned in a foreign corporation. These tax regimes are generally intended to prevent abuse of the tax system by moving income into a low tax country and avoiding paying tax in the home country indefinitely until a dividend is paid to the shareholders. But unfortunately, these rules also affect a lot of other taxpayers that have a legitimate business in a foreign country, but are nonetheless subject to the reporting requirements and tax implications of these regimes. So for a US citizen living in Canada who owns a Canadian corporation, we would be concerned about a status called CFC. And to define a CFC, we actually need to define what is a US shareholder first. So a US shareholder is generally a US person with at least a 10% ownership interest in that foreign company. And that 10% could be measured based on voting power or value of the company. So cumulatively, if these US shareholders control the foreign company, meaning that they own more than 50% of the votes or value, it would have CFC status, and those US shareholders would have additional reporting requirements on their US return and may be required to pick up that Canadian company's income on a current basis instead of when they receive a dividend. If this accrual of income applies, then future distributions from the company are generally tax-free because it's treated as a distribution of previously taxed income where the shareholder has already satisfied their tax liability. So on the US side, it is subpart F of the tax code that imposes these rules. Traditionally, it was intended to capture more passive types of income, such as interest, dividends earned in a foreign company, would be repatriated to the US on a current basis. But in addition to those passive types of income, there are certain types of businesses, such as professional practices. I think medical practices that are incorporated in Canada is a common example of business income that's deemed to be passive and that is required to be picked up on the US return on a current basis. And in 2017, we had a substantial reform to the US tax code, which introduced this concept called GILTI and even further expanded the types of income that might need to be picked up on a current basis. So GILTI is generally intended to capture intangible income. But the way that it's calculated can unfortunately capture active types of business income and subject it to US tax on a current basis. So if we compare this to the Canadian side, this company is treated as a separate taxable entity for Canadian purposes, and the shareholder level of tax does not apply until a dividend is received. So that's why we see a potential timing difference between Canada and the US. And we generally want to pay sufficient dividends in Canada to align that timing and prevent any shortfalls when we try to claim a foreign tax credit. I will compare this against the Canadian FAPI regime, which is somewhat comparable. So if you have a US company with Canadian owners, there are similar rules that might require that US companies' profits to be taxed on a current basis in Canada. Generally, the FAPI regime only applies to passive income such as interest and dividends, and active business income earned in the US would not be subject to FAPI accrual. Also note that the ownership thresholds that would subject you to FAPI are different in Canada compared to Subpart F in the US. So in Canada, you still need to control the foreign corporation. It can be direct or indirect. You also need to have at least a 1% direct ownership percentage in the foreign company to be subject to FAPI.
Now, I know, Kristjan, also in the US, we have this concept of constructive ownership rules, and they matter. Now, how does that play into taxing this undistributed corporate income?
Right. So when we look to the ownership thresholds to see if there is sufficient ownership to be subject to these rules, in Canada, we're looking at the direct and indirect ownership. In the US, we also look at direct and indirect, plus this concept called constructive ownership, where a US person could be deemed to be the owner of shares they don't actually hold, but they could be deemed to own shares held by a related party, such as a family member or a related corporation. So sometimes even without sufficient direct or indirect ownership, you could achieve CFC status through constructive ownership.
I think that probably catches a lot of people by surprise, right? Because like unlike in Canada, you essentially what we're saying here is you could possibly qualify as that US shareholder, the 10% you're talking about, solely from shares owned by what it seems like owned by a related person or related entity.
That's right, and unfortunately, it does catch some taxpayers by surprise. Um, there are significant penalties if you fail to comply with the reporting requirements, so it's very important to have a complete understanding of the ownership structure and to consider these CFC issues. It tends to be a rather expensive miss.
Also probably why it's really good to make sure when we're doing our advisory work or even compliance to really make sure you have that full structure organizational chart so we know all the different entities and related persons that are in that overall ecostructure. Now, the other thing I want to ask is, I know we're talking about with CFCs in the US that's owning over 50%. You mentioned in Canada, you need to have at least 1% direct or indirect ownership. Now, when you say controlled foreign affiliate, does that also require that the Canadians also have control over that foreign affiliate of over 50%? With a
Yes, so the FAPI rules are intended to apply to taxpayers where there's Canadian control over the foreign corporation.
excellent. So that it's a similar construct there as well. Excellent.
Can we move on to the next slide, Namir?
All right. I guess that bringing us then to trusts. All right, and just for the record, as we're talking through this, we keep saying, U.S. persons or U.S. owners or U.S. citizens. Just for simplicity's sake, I think both Kristjan and I are referencing, U.S. citizens or U.S. green card holders. And again, for the reference of a lot of these examples, we're thinking of it from the perspective of that U.S. owner being in Canada, bringing their business to Canada using a Canadian entity. But with this overview here on trusts, really what I'm wanting to think about is, if you are a US citizen, if you are a green card holder, and let's say your entity of choice for doing business in Canada is a trust, I want you to be aware of similar to what Kristjan just did with the corporations and the differences between the US and Canada. There are some crucial differences here in the treatment by both countries. While there are, of course, some similar approaches to how trusts are taxed, there are some key flags I want you to look for, again, if the trust is your entity choice. I'll jump again, similar to what Kristjan did here, between some of the high-level similarities and differences in how US and Canada taxes these trusts. So I'll start first with the attribution of income. There's some similarities here. Both countries may tax the person who contributed to the trust on that income or gains that are earned. In the US, that the contributor is also called a grantor or an owner. But there's also some notable differences. If you're making a loan to the trust, the US could see this as a contribution unless it's done on fair market value terms. You also have to be careful because in the US, you can also be treated as a grantor from any interest or powers of your spouse. And in Canada, we also we generally think of attribution of income applying when the income is earned by a Canadian resident contributor. But in the US, that attribution of income can actually also apply in cases where the contributor is a non-resident of the US. Now, with regards to taxation of trust income, really trust income, the way we think of it is it's earned in the trust and it's going to be taxable generally either to the trust or to the beneficiary, generally when it's allocated or paid by the year end. One key difference here to think about, though, is the US does also allow for a 65-day post-year-end election for that income to be allocated as if it was actually paid by the year end. So then it gets taxable to that beneficiary at that year end. Now, both countries have a similar way of distinguishing between what we call a resident or domestic trust. So you get taxable on your worldwide income versus a non-resident trust or a foreign trust, where you're essentially getting taxed only on your local income from sources within the country. Now, again, why these distinctions still matter, though, is that the rules for determining trust residency differs, and that can sometimes lead into situations where a trust is, it could be a resident in both countries, or it could be a resident in neither country. So really, while there are some similarities and differences, I guess my main takeaway for you is you really do need to be thoughtful how you structure your trust, especially if you think you will have a US beneficiary or a contributor to that Canadian trust. There is some, with planning techniques in Canada, there is a possibility to even structure those distributions from, let's say, a non-resident trust in a way so that any distributions that are received by a Canadian resident beneficiary may not be subject to Canadian taxes, but that kind of planning is actually difficult for US beneficiaries. They'll face stricter rules on these kind of distributions from a Canadian, foreign trust. And the reason for that is, the US really, the rules are trying to discourage this type of deferring of income recognition, where you're accumulating it in a foreign, let's say Canadian trust rather than, and then distributing it later. One final comment here on our slide is, it's an important takeaway, an important point here is in the US, trusts can actually be really effective structures for protecting your assets against US estate or gift taxation. And that could be, to the contributor, to the trustee, or to the beneficiary. But again, you really need to be careful how this is designed to ensure you are getting access to these benefits. Now, in the US, we also have these taxes. They're called, the estate and gift taxes. These taxes generally apply to, really everything a US citizen and a domicile own globally. Any sort of gifts you're giving away during your life or you leave behind when you pass away. Now, right now, each person can protect up to, I think it's about 13.6 million. So that's your lifetime exemption from these taxes. But why this matters is this amount is actually going to be reduced about $7 million. That's like indexed to inflation in 2026. So this is, when you think about this as when you have any sort of gifts or bequests that you're making, and this is meant to offset that. So really, a consideration here for clients is, if your wealth is between those two thresholds, that's 7 million and 12.06 million, you'll need to plan carefully how to minimize those taxes. And, for wealthy individuals, a smart strategy could be to start transferring assets and, looking at who do you have as family members, possibly those who may be non-US citizens or non-domiciles, those who may have a lower net worth, anybody who could potentially even absorb it within their own lifetime exemption amount. But the recommendation here, again, if you could have a takeaway on this, is take advantage of these current higher exemptions before they potentially decrease. Or if, again, you're a US owner and you have this Canadian business that you're building and the value you think is going to grow significantly, this is a consideration you need to have. And trusts are commonly used for this purpose. But again, there's a lot of flags that you need to be considerate of here when you're looking at these different strategies. So for example, if you're keeping too much control over these assets that you're transferring, the IRS may come back and say, hey, we're still considering this part of your estate for tax purposes. Even a consideration to have in these planning strategies for your trust and for your estate is, if you're an individual, you have a high level of net worth, a consideration may be that it's likely safer not to serve as a trustee or beneficiary of that trust, that you have conferred that value. Now, another concept I wanted to introduce here is, the cross-border considerations for what we call an estate freeze. And, in Canada, this is a common strategy. It's used to manage your taxes effectively. All it really is freezing the value of your assets and transferring future growth to your family. Now, things to keep in mind here with an estate freeze is, this strategy does face challenges in the US because there's different rules around how the assets could be valued for tax purposes. And there's risk for that US person that, that Canadian estate freeze may not escape the US gift or US estate taxes. So if you could walk away with 4 considerations from this, be careful who you're choosing as your trustees, who's managing the trust, and the beneficiaries, who's actually benefiting from the trust. And if the trustee isn't clear about who should benefit from the trust, this could possibly create some tax issues for you. And again, while estate freezes are common and they're an effective way to pass wealth to the next generation in Canada, work with your cross-border tax advisors to adapt these strategies also for US tax laws. There really needs to be careful consideration of how these assets are valued and who can benefit from them. Really planning your estate as a US citizen just involves really thinking ahead, taking these proactive steps, hopefully transferring these assets early to maximize the current tax benefits, setting up the trust carefully, and really making sure, again, you're understanding both the US and the Canadian tax rules.
So we have one more polling question. What is the key difference between Canadian and US tax rules? IRS taxes citizens on worldwide income, even if they don't live in the US. CRA does not have capital gains tax, or IRS eliminated corporate income tax.
God, wouldn't our political landscape look so different if B or C were correct? Eliminating corporate income taxes would be a dream for a lot of people. That sounds like a great option. There's been some legislative changes. I think you brushed on it earlier about changes to the capital gains tax in Canada. But these absolutisms and these multiple choices make for fun answers.
Yep. So we've moved the other direction with potentially increasing
All or
capital
nothing.
gains in some cases. Okay. A 95% success rate there.
Good score. All right. We're going to go into some of the cross-border tax planning strategies here to think about. Look, if you're a US person, as we talked about earlier, and you own a Canadian business, you're likely dealing with taxes in both Canada and the US. And, prior to 2018, a lot of us as cross-border tax advisors, we were primarily thinking about whether our clients were going to be subject to the Subpart F rules, the passive income rules that Kristjan alluded to earlier. And the reason for that is, a lot of times, if you weren't mindful of it, these were going to lead you to very high taxes for those US citizens who own the Canadian companies. And if you remember how Kristjan walked us through that, you're a Canadian company, you're making money as a Canadian corporation, so then you're paying Canadian corporate taxes on that income. And then, okay, you want to get the money out of the company. So you bring that money, let's say, back to you as a US person. Now you're paying US personal taxes on it. But there's also Canadian personal taxes on it. If there's any future dividends paid by that Canadian company, again, assuming as a US person, you live in Canada. And then there's that extra 3.8% tax on investment income in the US for any dividend received. So, in that kind of road that you're going through as a US owner, owning a Canadian company, you're crossing multiple tolls. You're getting taxed multiple times on that same amount of money for your Canadian company. And one of the concerns you have is, do you have access to foreign tax credits? Normally you might think, okay, well, I'm going to get a credit for on my US taxes for any of the corporate taxes, the Canadian corporate taxes that I've already paid in Canada. But with the subpart F income that Kristjan alluded to earlier, you're not going to be able to generally claim this credit. So you end up in the situation, how these strategies we're looking at is, okay, well, wow, you're paying a lot of taxes. So what were some of the strategies people started with to really avoid these heavy taxes, and how did they work out, post 2018 tax reform? Well, one of the main strategies people started with was, can we keep this subpart F income, this investment income, low? And the idea here is that one strategy you can have is if you can have the Canadian company not have as much investment or passive income, which is a type of income that's triggering these high US taxes, that's one way to avoid this. But again, this is easier if you're a operating company that's mainly making money from selling a product or a service. Not so easy if you have an investment holding company. Another strategy would be, well, can I just avoid the subpart F designation altogether? If let's say your company was providing personal services, there would have been ways to say, okay, can we explore whether we can draft the contracts in a way to having that income be classified as something other than subpart F income, so you're not actually seen as a personal service provider. Now, another popular choice would be looking at the ownership structure, looking at a different entity choices. Now, if you remember, Kristjan mentioned earlier that when we're talking about a controlled foreign corporation, that to be deemed a US shareholder, you need to be owning at least 10% or more of that Canadian company. So one planning strategy, again, if it was available, it depends on the flexibility of, what are you trying to achieve with this business and who are you working with, who are your partners. But, can you structure the ownership in a way to avoid being classified as a US shareholder of that foreign corporation? For example, maybe you can make sure that no unrelated US persons owned more than 10% of the company, or that the Canadian entity didn't qualify altogether as a controlled foreign corporation, a CFC. Another approach in kind of, again, looking at the entity and structure choice is to say, can we potentially set up the Canadian business as a hybrid flow through and claim some of those foreign tax credits? But again, this type of strategy really would only work well if your overall income isn't too high, because that would essentially mean that, sure, you're getting the foreign tax credits, but you're still, as a US person, picking up personally that income versus it being picked up by the corporation. Another strategy people looked at was, paying out profits. So this was a strategy available if you could say, hey, you know what, can I pay most of my profits out of this to my US owners as bonuses? So essentially what you're saying is you're leaving your Canadian company with not much income left to be taxed. But again, the issue with this here is that the strategy leaves the owner managers with potentially higher personal tax bracket in Canada, which again isn't ideal. Now, there is, the Section 962 election. This was a special tax election. It's been available in the US even before 2018. And what this allowed as a strategy for US owners to do is it allows you to pay taxes at the corporate rate instead of at the individual rate. But again, it was rarely used before 2018, and as well, it had its own kind of set of complications. Even with all these strategies, and again, I'm going to talk into how these strategies have shifted or how they look different after 2018, again, with tax reform, what are we seeing evolving right now as tax strategies? But before I jump into that, I want to say that even with these strategies, let's say the person potentially avoided having that CFC status, or maybe they could mitigate the amount of subpart F income they're picking up, there's actually still some challenges. One of them is you're still left with that 3.8%, what we call the net investment income tax. And that's going to apply to your investment income. For example, if you're getting a dividend from a Canadian corporation, and especially this is for US taxpayers, at the higher income bracket, the higher income threshold. And this can't be reduced by foreign taxes. So it is an extra foreign tax credit. So it is an extra cost for you to consider. And I'm going to touch on a few things that Kristjan mentioned and see how it all ties in together. But capital dividends, in Canada, some of those dividends can be paid out tax-free. But again, those same dividends might add another layer of complexity for you. And then the return of capital. Canada allows companies to return capital to shareholders tax-free. But again, the US will only allow this after all earnings and profits have been distributed. So again, this is a difference that could potentially cause additional taxes. And then on capital gains, the fourth one, the US doesn't offer a capital gains exemption, what we call the lifetime capital gains exemption, on the sale of Canadian or foreign companies. So that lifetime capital gains exemption, while it is available for Canadians on the sale of qualifying small business corporate shares, the US would tax those gains, again, which could result in this double taxation. Now, I want to jump into showing, and this is kind of, again, we're talking through the strategy as they were before the Tax Cuts and Jobs Act. What happened after? Well, so in 2017, we have big changes in tax law. This is what we call the Tax Cuts and Jobs Act. This was passed in the US, and it really impacted US owners of these controlled foreign corporations. And a lot of times when you heard the buzz around how this impacted cross-border multinational companies, a lot of times we were thinking, well, wow, this is really primarily targeting US multinational corporations. But of course, it also impacted US citizens, US persons, US green card holders who owned, for example, these foreign corporations. And so if you had a controlled foreign corporation and you were also living in Canada and earning business income through these Canadian corporations, there's some impact for you. So three major changes that we saw from the Tax Cuts and Jobs Act. First one was the transition tax. So the transition tax, this was essentially a one-time charge or tax on the profits that US shareholders had accumulated in these foreign corporations up to the end of 2017. So if you had a Canadian business and you've been retaining some of the profits in the company, the US said, we're going to tax you on those profits. And then we have the unfortunately named GILTI tax, Global Intangible Low Tax Income Tax. So what this is starting in 2018, US shareholders of foreign businesses, like Canadian companies, they have to start reporting and paying taxes on their share of the company's profits every year. So this includes most types of business income that really wasn't previously taxed annually. So essentially, if you're earning business income in Canada through your Canadian company, you now had to include that income on your US tax return. And the final kind of big change, which I think a lot of people are aware of, is the lower US corporate tax rates, again, going from 35% to 21%, which also impacted how US business owners were planning their taxes. So let's break down kind of how this has impacted US citizens. I'll start with the transition tax. When the transition tax first came out, when people first understood what this really meant, it was a bit of a shocker. And the reason for that is it was this one-time hit in 2017, for the profits that you had left in your Canadian business. Like imagine you've been saving your business profits within that company, and then suddenly you're taxed on those savings. Now, the good news is after paying this tax, the tax profits can then be withdrawn from your business without paying additional US taxes. So, they have this concept where the calculation of your earnings is now going to be called previously taxed income. And what that means is it allows you to then withdraw that later from your Canadian corporation without additional US taxes. But again, this initial tax bill that hit was pretty large for some business owners. And then with the GILTI tax, look, starting in 2018, the GILTI rules kicked in. Previously, as Kristjan had walked us through this, if your Canadian business was earning income, you really generally didn't have to pay US taxes on that active income until you brought that money back to the US. Or back to you personally as a US owner. So US shareholders were primarily concerned with that passive, the subpart F income. And that's again, typically passive investment income. It could be gains. Sometimes it could be the personal service contracts that Kristjan mentioned. But what GILTI did is it broadened that scope. So you now have to report your share of the business's income on your US tax return every single year. So if your Canadian business is making a profit, you could potentially, again, face this higher combined tax rate from both Canadian and US taxes. So how do our tax planning strategies look now after some of these 3 significant changes? What looks different for planning ideas or planning strategies for US owners? Well, the first thing is, again, you really do need to look at your cross-border structure, your entity choices. Are there possibilities, are there strategies available to, for example, structure your Canadian business as, again, a hybrid flow-through to allow you to claim those foreign tax credits for any taxes you pay in Canada, and potentially, hopefully, lowering your overall US tax bill? Are there, again, possibilities to do that bonuses and distribution planning? So planning how you pay profits of your business back to you as a US owner. That could be as a salary, that could be as a bonus by the end of the year. But essentially what you're doing here as a strategy is you're trying to reduce your overall business's income and hopefully lowering that potential GILTI. But again, this has to be weighed against other strategies you have. Are you potentially, by doing this, losing the benefit you have of deferring Canadian taxes? Now, the other 2 things to think about here that are important is, we have elections and we have exceptions. There is the high tax income exception. So if your Canadian business is eligible for that high tax income exception, you might be able to avoid GILTI altogether. And then there is that 962 election, which we said, wasn't used much before, but, what this allows you to do is get taxed at the US corporate rate. So that's the 21%, on your GILTI income instead of your personal rates, which, those could go as high as 37%. So, you'll also get to claim some credits for the taxes you paid in Canada, and this could hopefully overall lower your US tax bill. So with these planning strategies, I think it's important to just really think about, be careful in your annual planning, be considerate of, what type of elections you want to file, and making sure you're understanding how these changes, how these strategies are going to impact you as a US owner that has a Canadian entity to do business in Canada. And I think with that, we're going to polling question number 3. Kristjan, you want to take us away here?
Sure. So what income category did the introduction of GILTI in the Tax Cuts and Jobs Act of 2017? What income category was expanded to include for US shareholders of CFCs? Only passive investment income, active business income, or C, personal service contracts?
Again, I think this is one of those changes that really, I think, significantly altered our cross-border tax landscape in terms of structuring and advisory on how to run your cross-border business and being considerate of, what is going to be an efficient, optimal structure to have, knowing that you're potentially picking up, I'm not going to say the answer, but a certain type of income. Excellent. Looks like most people got that right. So that's right. It's answer B. Again, before the Tax Cuts and Jobs Act of 2017, US shareholders of those controlled foreign corporations, primarily had to report that, passive investment income, gains, again, some of those personal service contracts as part of their taxable income under what we call the subpart F rules. But with this introduction of GILTI, that scope expanded. So it really meant you're picking up that active business income. And so if you're a US citizen, a US resident, you're a green card holder, and you own those CFCs and you're earning income from active business, operations, and now you're being required to include a portion of that income in your U.S. taxable income, regardless, by the way, of whether that income was distributed to them or not. So you may still have that income in that Canadian entity. And look, this really, it's significant. It's a significant change, and it broadened the types of income in your entity that are going to be subject to U.S. tax as a U.S. shareholder, and how you're going to plan and report this type of foreign Canadian income to the IRS. All right, that gets us to our Q&A portion here. I think with today we've had the opportunity to explore some of these challenges for U.S. citizens, that are residing and expanding their business to Canada, and some of the challenges in managing taxes in two countries to avoid double taxation, and how to mitigate exposure to new tax liabilities. Kristjan, any final thoughts before we jump into the Q&A?
Let's move into the Q&A.
Okay, let's do it.
Okay. Thank you, Namir and Kristjan, for the webinar on the U.S. businesses expansion to Canada today. We do have a couple questions for you. The first question is, does GILTI income capture all my Canadian entity income, regardless of the type of activity I have?
If we could flip back a couple of slides, I'll provide a bit of an overview of how GILTI is calculated and what income would get captured. When a U.S. shareholder has a CFC, they attach a Form 5471 with the return, and it's essentially like a small corporate tax return where we measure the profits of this Canadian business using U.S. tax law. And once you determine the U.S. taxable income of that business, you carve out a portion of it that is deemed to be tangible income. So again, GILTI is meant to target more of the intangible sorts of income. And how they arrive at that intangible amount is to take your total taxable income and remove the tangible portion. So there is an opportunity to have some active business income that is not subject to GILTI if it's included in that deemed tangible income, which is generally calculated using 10% of the adjusted basis of your fixed assets. Namir, do you have any other thoughts there?
I think that's a good summary. Well done. I guess maybe the other thing here is just a good thing to think about too with GILTI is, there is that threshold where you're looking above a certain amount of percentage of your return on the tangible assets. And so one of the considerations always with GILTI, again, as a U.S. owner of a Canadian corporation, is knowing, what's actually in the company to understand whether you're going to be subject to GILTI or not. So looking at what proportion of your income are you deriving from, actually hard assets, these tangible assets, versus, are you deriving a lot of your income from intangible assets? And I think that type of distinction can also help you understand whether there's opportunities to manage your GILTI exposure as a U.S. owner in these Canadian businesses. Thanks, Kristjan.
Thanks.
Thank you for your answer. The next question is, you mentioned about the exception and exclusion for FABI and CFC income pickup. Can you walk us through when that happens?
Okay, let me just go back to the slide real quick. Give me a second. All right. That's right. So we did mention that there are some exceptions and exclusions that apply on how you're taxing your undistributed corporate income. And for example, and we'll talk about this from just the passive income portion in terms of subpart F, or in Canada, the FAPI rules. Both have these exceptions and exclusions. So for example, there is the concept of a de minimis threshold. So for example, with subpart F, certain categories of the CFC that you have, if that income is below, for example, 5% of the overall company, the controlled foreign corporation's gross income, or $1 million, then that income category could be disregarded for purposes of subpart F. With FAPI on the Canadian side, if that amount is less than $5,000 for each controlled foreign affiliate, then you'd be considered below that de minimis thresholds. Now, with subpart F, there's also other considerations. The subpart F inclusion is still limited to your current earnings and profits in terms of what's included on that U.S. shareholders' taxable income that hasn't been distributed. You also have the high tax exception, which I think we briefly touched on. So, looking at whether that item of income is taxed at more than 90% of the highest U.S. tax rate. So that would be looking at 90% of the U.S. rates. Then you have other exceptions. We're not going to touch on that. It's another webinar on its own in terms of same country manufacturing exceptions, same country sales and use exceptions, which aren't used again as much. You don't see as much of those post 2018 after the Tax Cuts and Jobs Act. Those would be some of the exceptions and exclusions I would consider for both US and Canada on subpart F and on FAPI. Are there any other questions?
Thank you, Namir. I think that's all the questions we have for the today topics.
All right. Well, I guess before we wrap it up, I guess just a few things to keep in mind. Look, it's really crucial if you're a U.S. owner, if you're a U.S. taxpayer, you want to understand, when and how your income is being taxed. Again, making sure you understand how the IRS and the CRA are identifying you as a taxpayer, knowing your source, nature of income, and just the tax implications of these different tax regimes. Strategic planning, structuring is key. You want to anticipate these complexities. Hopefully you can plan for it effectively and work with your cross-border tax advisors to help you understand the rules, the ones that you want to understand, to leverage opportunities that are available for you to hopefully grow your business in Canada as a U.S. owner. We will hopefully, please let us know if you have any other webinar topics you'd like for us to discuss, and have a great summer. Kristjan, thank you so much for joining us.
Thanks for attending. Thanks, Namir.